December starts with quite a busy week ahead of us in terms of scheduled company news. Two FTSE 100 firms, DS Smith and Berkeley, are both due to report first half results, and there are full year or interim figures or trading updates due from a good few mid and small caps as well, including Balfour Beatty, SSP, Paragon, Watches of Switzerland, Future, Victrex and Baltic Classifieds. Of that batch, infrastructure specialist Balfour Beatty and house builder Berkeley may make the biggest headlines, especially as their industries are both priorities for the new Labour government, given their importance for the wider UK economy. Balfour Beatty is due to report its year-end update on Thursday the 5th of December. The FTSE 250 index member shares are up by a third in the past year and stand pretty much level with the all-time highs reached in 1989 and 2007. So it's fair to say that expectations are pretty high. Balfour Beatty's key sectors are transport, energy and defence, as well as social infrastructure, including residential housing, hospitals, schools and campuses. It also has a construction business in America and a 50-50 joint venture with Jardine Matheson based in Hong Kong. A £16.6 billion order backlog as of June, plus £1.3 billion in investments in projects, are both testament to the scale and lead times of the work that Balfour Beatty does. Order book trends will be one of the first figures upon which analysts' forecasts will look, and then they'll turn to Chief Executive Leo Quinn for four more important details. The first is revenues, where current analyst consensus is looking for an increase of around 1% to £9.7 billion for the full year. Underlying profit operations is second, where the market views £236 million, a fraction above last year's £228 million. Then gains on infrastructure disposals, where Mr Quinn's guided previously to £24 to £34 million, compared to £26 million in 2023. And then finally, the average monthly net cash pile, which of late has come in around £700 million to £750 million. Balfour Beatty is not likely to formally declare its full-year dividend until the actual results next spring, but the firm is currently committed to £60 million in total payments this year, the equivalent of around 12 pence a share. The company is also running a £100 million share buyback programme, including 2024's forecast dividend and buyback numbers. Balfour Beatty will therefore have returned some £750 million to its investors in just 4 years, or roughly one-third of its current stock market capitalisation. Meanwhile, Berkeley's full-year results for the 6 months of October are scheduled for Friday the 6th of December. Concerns that interest rates could stay higher for longer, thanks to inflation and ever higher government debt, have hurt Berkeley's share price this autumn, just as 2020's all-time high had come within reach, and overall the shares have lost around 10% over the past year. Berkeley's September trading update was pretty clear. Management expects the high-end house builder to generate £525 million in pre-tax profit in the whole year to April 2025, with a weighting toward the first half, which will mean the operating margin may even exceed the long-run target range of 17.5% to 19.5% in this 6-month period. Note Berkeley's already suggested that April 2026's pre-tax income will be around £450 million. In the first half of last year, by the way, as a benchmark, Berkeley reported sales of £1.9 billion, an operating margin of 19.5%, and a headline pre-tax profit of £298 million. After those headlines, analysts will dig into the details to see how certain key figures and trends could shape future earnings, where Berkeley still has a plan to make £1.5 billion in total pre-tax income across the 3-year span to April 2026. Trends to note will include forward sales, completions and average selling prices. The former came in at 3,521, the latter at £664,000 across the whole year to April 2024. Input cost inflation, updates on the 32 brownfield regeneration projects, 27 of which are already running, further comment on the Berkeley build to rent or BTR platform, and any updates on potential cladding and remediation costs. After that, attention will turn to cash returns, where Berkeley is deploying a combination of ordinary dividends, special dividends and share buybacks, with a minimum ordinary dividend of 66p a share as part of a total return plan of £283 million in the 12 months to September 2025. One final point to note will be the net asset value, or NAV per share figure. That stood at £33.63 as of April. Given their cyclical earnings, house builders are often valued on the basis of price to book or price to NAV. These multiples have come down sharply in the past few months across the sector, As enthusiasm has faded for the government's deregulation drive and goal to get 300,000 homes a year built, and attention switched to interest rates and taxes, plus the possibility of ongoing higher cladding and remediation costs. Berkeley's high-end exposure, premium margins and cash returns mean it currently trades at the most expensive house builder on a price-to-book basis, with the accident-prone Crest Nicholson looking like the cheapest. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.